Throughout the day today, we've been hearing and increasingly talking about how we find ourselves operating in a complex global environment that's mired in uncertainty. Uncertainty has been a theme that's been pervasive on every panel today, and we've talked about it from the context of the Eurozone, we've talked about uncertainty in the Middle East, we've talked about the slowdown in China, and we've certainly talked about the US policy landscape and some of the economic issues that we're working through here. So given these immense and what I consider to be interrelated challenges that we're facing globally, how do you effectively deploy capital across borders today?
First of all, I think,
question, I know.
well, first of all, I think uncertainty is here to stay anyway.
Yes.
So, in order to make good asset allocation decisions, I think you have to go down to fundamentals. And in addition to the fundamentals, we need some faith in what's going to happen in these different areas and in different countries. And whenever the faith, the trust in what's going to happen, and the economics fit together the best, then we would invest there.
Now, in DLA Piper's 2013 State of the Market Survey, we found that Brazil, Australia, and China, in that order, are seen as the most attractive international markets for foreign investment. Now, how does this compare with where you see the greatest investment opportunities from where you're managing money from Germany?
Well, I'm very glad that that was the outcome. We are investing already in 20 countries around the globe. And we are active in China and in Australia, not yet in Brazil, but that fits very nicely with our strategy.
Okay, now which of the Asian markets are you most bullish on, say, in the next 6 to 12 months?
Well, for the Asian markets, I would see Japan as really kind of a trigger in what's going to happen there, as you can buy still at very attractive levels. I would also see Singapore as a very attractive market, as they are just coming out of, well, they're bottoming out.
Okay.
And then I would say Hong Kong and China, in
Okay.
that order.
Japan I find interesting. You know, in a lot of the discussions, and there's been a, very much a global theme today, there hasn't been talk about Japan. Can you talk a little bit more about the attributes of the Japanese economy and the commercial real estate markets that you guys find attractive right now?
Well, that is for the background that I'm living and working in Germany. So Japan is the perfect example that real estate is doing extremely well throughout 2 or even more decades of very slow growth.
Okay.
And very low interest rates. So the spread between the government bonds and real estate returns is really high. Nevertheless, the returns overall in Japan always used to be very low in real estate. So now we are back to attractive levels in the range between 5 and 6%, which might sound low from a US and a European perspective, but from a Japanese perspective, it's twice as high as it used to be. So if it's twice as high as it used to be, then there is a lot of room for arbitrage in the future.
Now, you mentioned during the panel that we are actually moving toward a trend of investing more inwardly within home countries, which some could say that runs counter to the trend of cross-border investment. But if we're going to be investing more inwardly within home countries, that means perhaps that you're going to be looking at a number of opportunities in Europe moving forward. Can you talk a little bit about the inward trend and what's driving that?
Well, the main driver for the inward trend, I think, is the risk averseness of, well, every investor.
Yeah, right.
And the risk-focused legislation put on most of the institutional investors. So usually all the legislation is going into the direction. It's a little bit easier to invest at home than abroad. And then we heard something very interesting today morning from Sam Sell, because at the end he said, well, going abroad is always a question of arbitrage. So, and that is a big question for the Germans these days. When I go investing somewhere else, do I really get higher returns? And the answer is, in many cases, no.
I want to ask you this too, just to wrap up, and that is, we've been talking a lot about policy. And what domestic U.S. policy issues are you closely monitoring as it pertains to deploying foreign capital in the U.S. commercial real estate market? And I know we talked in your panel about there being any number of barriers to investing in the U.S. And a main one, chief among them, is the Foreign Investment in Real Property Tax Act, also known as FIRPTA. Can you talk a little bit about what this particular policy issue, the impact that it's had?
Well, the US is a very open and foreigner investors friendly country usually. But as always, everything nails down to bottom line results. And if you increase the tax burden for the foreigners, that has to be factored into it. And then these foreign investors will compare the US investments with other investments somewhere else. And if the bottom line result is more beneficial in other countries, they will just invest in other countries. So therefore, for us, the biggest hurdle these days is really FIRPTA, FATCA, and we have some other tax issues going on. That is a real obstacle for us.
Again, that was Barbara Knoflach, CEO of SEB Asset Management. Barbara, thank you so much for joining us.
Well, thank you.
Really appreciate it.